What's up, everyone? It's Scotty with MoneyVest. So, we got to talk about the markets. What's going on, folks? We are seeing a pretty reasonable sell-off, and the S&P 500 is down almost 1%. The Nasdaq is down a little bit over 1.5%. We talked about how technically the markets continue to look a little bit more on the weaker side because we got up to the all-time highs once, twice, three times. We retested it. We weren't able to break out of it, and that already kind of gave me a little bit of a sense that markets are starting to look weak from a technical perspective, and there's not a lot of buyers to push past certain levels. And we were making, of course, lower highs and lower lows as well, which is obviously resulting in a much bigger sell-off right now. And the media and, again, a lot of the narrative is going to be around finding a catalyst, what's going on, why the markets are selling off. Relax, everyone. There's just a normal pullback, normal correction. The markets have done really well over the last 3 months, not to mention over the last 12 to 18 months. So because of how much momentum we've seen, it's very normal for the markets to pull back and see a little bit of a dip or a correction. There's nothing wrong with that. And there's going to be a constant need in search for a catalyst. What's going on? What's going on with Iran? And of course, the oil prices. Are they going to spike? What's going on with interest rate expectations? What's happening with retail sales? So there's going to be a lot of questioning around what's causing this sell-off. And sometimes we don't need a reason, right? Markets can do what they want to do every single time, right? They can just be in their own element because the markets at the end of the day is really just a combination of mass thinking. You and I make the market. Our thinking makes the market. Our decision making makes the market. So it is very normal for us to see a bit of a pullback here. Now, before we get started, I do want to mention that I posted a members only private video. This is part 1. I will be posting part 2 later this week, but this is essentially the title, Time to Buy. Don't miss out my entire playbook, and I will be going over in this video all the ETFs that I plan to buy, as well as specific prices, and more importantly, the degree of intensity. And that degree of intensity is going to be broken down into 4 or 5 different things, basically my nibble price, my light buy price, my heavy buy price, my no-brainer buy price, and my close your eyes and buy price for ETFs, along with 5 indicators to watch and a combination of those indicators to optimize your risk and reward. So this should be a very helpful and very actionable video. 9 minutes long, that's all you have to do. You have to look at a spreadsheet, and there's going to be a listing of my prices and the ETFs and a combination of those 5 metrics with all these different columns on what the intensity is going to look like for these ETFs and how and where I'm going to buy them. So link's going to be down below if you want to join. Limited spots left, and for part 2, we're going to break down individual stocks. I'm going to break down my entire shopping list, share it with all the members, and these are the stocks that I'm planning to buy at certain levels as the markets here continue to sell off. So don't miss out on these opportunities. We've talked about how volatility higher, markets lower is a perfect good combination to be dollar cost averaging into the market. So this is where we are. Nasdaq here under 16,000, S&P 500 at 5,074, and the Dow Jones here 37,784. Obviously selling off quite aggressively here. S&P 500 profit estimates are also dropping, with analysts also lowering the bar for corporate America to beat expectations. And then, stocks obviously retreated on Monday. Goldman Sachs reported some very good numbers, so overshadowed by the strong Goldman reporting earnings, hard retail sales data, and hope that the conflict in the Middle East will not escalate further. And the S&P 500 slipped 1.1%, swinging to a negative territory after trading up as much as 0.9% earlier in the session. The Nasdaq here tumbled about 1.7%. Salesforce and other technology stocks were particularly hard hit, with Tesla also reporting that I think they're going to cut about 10% of their global workforce, which is actually quite a pretty significant deal because one of the biggest expenses for any companies is payroll. And Tesla is, definitely cutting a lot of jobs, which could impact unemployment. Of course, will be a bullish catalyst in general because that is going to have a positive impact on the earnings, but we don't know how much of an impact it's going to have on sales and revenue and marketing and all that stuff. Higher rates poured cold water on the market bounce seen Monday morning. The yield on the closely watched 10-year treasuries rose above 4.6% level in the session and touched its highest point since mid-November. And yields popped after data showed that retail sales increased 0.7% in March, providing the latest indication that consumption remains strong despite inflationary pressures. And that pace was higher than the 0.3% consensus forecast as well. So, that's really it's quite an interesting market here because the stronger the economy continues to be, the harder it is going to be for the market to rally. And the reason I say that is because of interest rate expectations. The stronger the unemployment, the stronger the jobs market, the stronger the economic growth, the stronger the consumer spending, the stronger the retail sales, the lower the probability for rate cuts, the lower the probability for the Federal Reserve to pivot, the lower the probability for quantitative easing, the lower the probability for markets to rally, the higher the probability for the yields to be higher. So we've talked about the trouble trifecta. We were talking about this for weeks now, and how a higher yield is going to impact the US equity market. Okay, it's not rocket science. When yields go higher on a risk-adjusted basis, it impacts the US equity market. And right now we're sitting at 4.6%. Yields are up another 2.3%, which obviously is putting more and more pressure on S&P 500, not to mention technology stocks, because this is the risk-free rate. We use this rate to calculate the present value of all future discounted cash flows. So we basically use this rate to discount all future cash flows to present value, right? And if the yields are higher, the present value of all future cash flows is going to be worth less. Not to mention, earnings are going to be affected because interest rates are higher, so interest expense is going to be higher for companies. And as a result, a lot of things kind of snowball from there. So if you come over, take a look at technology. So all the FANG stocks, Magnificent 7 companies are down. Tesla being down almost 5% on the day. So really selling off pretty aggressively, not to mention Netflix, 2.5%. We got Meta down 2%. Apple, Microsoft, AMD, Nvidia, Google, Amazon, everything pulling back across the board, which was again expected. It was nothing out of the ordinary. This is something that we were expecting from the markets here, not to mention, of course, a lot of other individual stocks are also selling off on the day as well. So this is, again, nothing to be going crazy over. I will be sharing my entire shopping list with my price alerts and my buy targets on individual stocks. That's going to be for part 2, but part 1 is going to be for ETFs only. Now, if you come over to S&P 500, this is the chart that I mentioned in my market updates. We went up there once, twice, 3 times, failed to break out, triple top resistance. It was pretty clear, lower highs and lower lows. And this right here is a breakdown after perfectly testing that lower high here on the day. So we're selling off even further. And the next support I'd be watching on the S&P is going to be sitting right there at 5,055, kind of aligned with this previous resistance. You'll notice that we struggled to break out of this resistance here once, this right here almost twice. And then when we finally did, we gapped up. This turned into a support once, twice, and 3 times. So this right here is going to be that level to watch now for the S&P. I wouldn't be surprised if we do get a little bit of a bounce back higher, considering how oversold we might be on shorter time frames. So it is possible that we do get a little bit of a rebound, but of course, if this sell-off has any more staying power, then the next support really is going to be down in the 4,900 sub 5,000 levels, and that's exactly when the volatility is also going to be higher, right? VIX is at its highest level in all of 2024. It hasn't been this high since November of 2023. So again, these are the metrics that we look at, right? So the higher the VIX goes, the better the opportunities become for the market and of course for individual stocks as well. Talking about Nasdaq, same story, selling off pretty aggressively here. So this right here would be a very, very important level of support that's going to be aligned at around 15,900. So we'll keep a close eye at this level first, and of course all the way down to as low as levels closer to 15,600 for the Nasdaq as well. But this again is the constant lower highs and lower lows that we witnessed. Specifically mentioned the resistance at 16,485 in one of my previous videos. Failed rejection there. I mean, basically not able to break out. Sold off, got back up again, retested that resistance at 16,300, sold off even further. Bottom line is, I think it's really important for us to be ready, right? These are sell-offs that need to be taken advantage of. And I will be doing that. Our community will be doing that, and I will be putting out again videos like I said earlier. So this is going to be part 1, entire playbook on ETFs, and then the other one's going to be my shopping list on individual stocks with my buy targets and my specific prices as well, and a combination of indicators that we're looking at. These are market breadth indicators as well as a couple other ones that we look at very, very closely. So link's going to be down below if you want to join, and of course markets doing what they do best, and that is selling off, and we love that because that's really where markets give us the best opportunities, and the risk reward ratio is also very, very good. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel. As always, happy investing. I'll see you all in the next video.